With iceberg breaks, what we've seen is a situation where once the iceberg is defeated, you get a quick little snap through, which is people exiting, those who have partnered the iceberg or used the iceberg as a way of placing their stop behind it. You get those people get out, creating a little snap of action, and then you get continuation. What we're going to have a look at now then is a failure of that continuation, a situation where a market trades through the iceberg, fails to find any additional trade, and gets back above the iceberg. This essentially is a failed break of a level, or a level created, which then false breaks and is then held. So what you end up with is a situation that looks like this. Very, very short term, head and shoulders essentially. A market that trades down, meets an iceberg, gets a small reaction as one would expect, and then on breaking the iceberg, gets the low liquidity snap, quick rush down, everybody who's been buying here and here gets forced out. Great, but you don't get any continuation of selling. No more people come in to sell. And so when no one else comes in to sell, the market finds it easy to gravitate back up because the few people who will have jumped in trying to take advantage of the break are trapped. You end up with people trapped one way, trapped back the other. As soon as you're back above the iceberg, you can treat this now as a reversal, as an opportunity once again to buy here, but now with a defined stop. And this is a great way of playing a reversal. If you like the idea of this as a level, if it's a pre-established level and you want to buy it, the hardest thing to do, or the hardest part of buying a level on site, is where do you place your stop? Now, when you have this type of scenario, the flick down defines your stop for you, because this clearly is the point where you cannot find any more sellers to keep this market moving. So your stop can be defined below that low. Nice and clean, very clear, with good reason. Now, when you move back above where the iceberg previously was, this becomes a level again. Anybody who recognized this as support may well have been forced out, but they're going to be willing to get back in now because the support has come back. People jump back in, this gives the market some strength, and anybody who has been selling thinking that there's more chance to the downside gets pressured out, and the market then explodes towards the upside. You get this quicker reaction up as you then get shorts who are proven wrong, and buyers who now have been shown that this probably is a low, at least for the short term. And in seeing that, they now have the opportunity to add on to the trade, and the people then start to chase up and the market accelerates towards the upside. So that's what we're looking for. And it's the lack of new participants that's key. So when you see the break, this will happen in one of two ways. Either the break will come in a very, very fast snap and straight back, which is what we call a stop move, and we'll look at that in momentum reversals. It will either do it like that, or it will do it with a break that slows down completely, just runs out of all activity. The market goes from trading quickly into the iceberg, fast, and on the break, you get the quick snap and then no more activity. As soon as you get that, that's a good indication that this could be it, and it's a great sort of way of being confident of the trade. If you don't find any more activity, people are not interested in trading down here. And from the seller's perspective, that's not what they need. They need sellers. And if they don't get it, they're going to have to get out. That's the distinction between an iceberg that fails and an iceberg that breaks and continues, as we've seen in the previous couple of examples. I'm going to go and have a look at quite an extreme version to illustrate this in gold. And this is one where an iceberg has actually appeared over a couple of days. So we've seen it, and this is why it's so important to just take note of levels. Even if the iceberg doesn't break, if you note down the level that it's coming in at, you're ready for this the next time we get there. If you don't note it down, this just looks like any other level. You start thinking, yep, looks like a double top. But when you get back there, you get the iceberg again. So now you understand the strength of the level, that there's clearly a willingness to sell here. However, when you get back up there and it breaks, you now have expectations of what should happen. You've got a lot of people who will have been short the double top looking for this move. They're going to get forced out. We should expect a fast move higher and a continuation. If you don't get that though, this is a good sign that the only people buying up here are people who are forced to, taking their stops. And on the back of that, we've now got the chance for the market to drop. So this is what it looks like on a 1 minute chart. Very quick jump. The selling, the passive selling from the iceberg is overwhelmed. Very fast jump. It's around about 70 tick jump. And so you see the shakeout of velocity here is quite spectacular. And then you can use that to execute as you come back down. Like the oat one that we looked at, it's about letting the market settle slightly and then executing. You don't need to rush into this trade. Let's get the ladder up and we'll go and have a little look at this. So here we have it. We're going to be seeing gold starting on this drift up. Now, the level is 98.2. We've not quite traded that at this point in time, But for many people, they're going to be looking at 98.2 as the opportunity, once again, to sell. So at this point here, you're around about 20 ticks from the level. There's no reason really to want to be active in either direction. There's no need to rush in to buy, there's no need to rush in to sell on this one. And it is very much a case of waiting for the trade to develop, see what happens when you get towards 98.2. I'm always going to be looking at something like this, thinking, if we've traded this level a couple of times, I don't really want to sell this on site. Reason being, you know already, particularly if you've seen the previous absorption there, that there are a lot of people short here. If they get tested again, many of these people are going to look at this and think, do I really still want to be in this trade? And so therefore, being tested again could actually turn some of those shorts into buyers. People who don't want to and fear the stop out, jump higher. If people fear that, they may well get out as you approach the level. So therefore, I don't want to sell this on site. I want to see how the market trades when it gets there to make a decision. If you've got a lot of buyers as you reach that level, don't want to be involved. If you lack buyers, or if buyers run out, then you want to sell. So that's the way that you want to try and approach it, but having a plan before you get there as to what exactly you want to do. Now we do see a little bit of volume formed at 97. So if you're looking to try and play this to the upside, a break of 97 could be the opportunity early on to get into this trade to try and play for that break of high if you're looking to play this as an aggressive break towards the upside. But at this point in time, we now just backed off once again. We're still rotating in this area, but we started to pick up just a little bit of a hint of more energy coming there. Quicker flick down, market flicks back up. There's a clue, something is going on, and that's subtle. It doesn't mean directionally anything, but it tells you that there's a little bit more activity going on. There are little spurts of action which should indicate that potentially there is a move coming. If you're still watching this, you're still waiting for when this action comes together. In terms of reference points, we've just seen it trade 95.5. Always looking at this when I'm watching any kind of order flow, I'm just watching where are the recent points that we've traded. 97, 95.5 are those two reference points that you have. Now it starts to tick up. We've moved a little bit more pace again, 96 up towards 96.5, and again, see a little snap up. This all looks good. This is now interested, and boom, straight the way through. Now, immediately we trade up towards sort of 2004, and then straight the way back. Now, for anybody who's long, they're thinking, great. If they bought into that large order, or what was a large order, and this is the point, it was previously in absorption. If it goes back there and there is no absorption, everybody who's got a very obvious stop just above the level is going to get forced out. That's exactly what happens. Market jumps up. So now, if you're long playing into this, wonderful. You're potentially 30, 40 ticks on side, having actually at one point been pushing on towards 70, 80 ticks on side. The opportunistic buyers are now going to be very aware of where that breakout came from. If you go back below there, that's where they're going to start giving up on this trade. So like the oat one, it's about now waiting for the market to settle down slightly. We know where the reference point is, 98.2. We just traded there, flick back up. So you're watching now, where are we flicking back to? 99 was about the level. So you now have two choices. You can sell it below 98.2, or you can try and sell it around about 99. And there we go, nice and quick, down through 98.2. This is your opportunity to play the reversal. You clearly saw that once the liquidity came back after that initial jump, there was no willingness to buy. We trade 99 and struggle. And so yes, you're going slightly offside here by selling 98.2 and just below. That doesn't matter because you can see where the buying ran out. It ran out at 99. After that initial whip up and drop back, the buying disappears. And once you've got that, you've now got all the information that you need. You can take this trade on, treat this like a level now. So assume that you have sold the top of the range, not just on the very short term move, but also potentially on this longer term move to play it all the way back down the range. That's going to give you around about 170 ticks. Excuse me, 370 ticks actually, to get all the way back down towards the 1960 area, if you're playing for that longer move. Short term though, as a reaction, you've got reference points down here to be targeting, down towards 1994, quite comfortably and quite quickly, down towards the low before the breakout, which comes in at around about 89. So you've got a fair bit of space towards the downside to play for anyway here. But the key bit to this trade was once that liquidity comes back, once the market settles slightly, you saw a lack of buying. The buyers completely ran out at 99. And when that happens, that shows you where you can enter the trade. You either enter it around 99, where you're running out of buyers, or you sell it as you go back through the level. Once back below 98.2, the move to the downside is on. Your stop is clearly defined. You've got a 10-tick risk with potentially 40, 50, even 100-tick target to be playing for. And you can continue to use that 98.2 level throughout the rest of the day. It holds again and again as the day wears on. That's your opportunity. That's how to use that liquidation move. Very quick. People get forced out when the iceberg breaks, but they cannot find continuation. Without continuation, this trade dies, the market turns and rolls back towards the downside. Next up, we're going to have a look at a follow-on from this. So it's a slight variation on that iceberg break that we just saw. So it's an additional variation using a previous iceberg, like the previous example, and the one that we saw earlier. Now, the iceberg that we saw earlier in gold held the market on a fast drop, and the market then rotated, and you saw that iceberg coming in again and again and again. That created a small range, and then once that range broke, you then got the escape, the quick move away from the range. The iceberg held, sellers became exhausted, the iceberg prevents sellers maintaining that pressure, and then the market rotates back up. That doesn't mean that the move is over. And if you find new sellers on the back of a market that does not continue higher, now you can have another shot at the iceberg. But in a way, think about this as another shot with a run up, if you will. You're coming from higher up, you've got reference points to work with as well, generated by this previous action. You have that previous range. So this was where the iceberg held, and then you got that quick break towards the upside. That was through this 1799, if you recall. So falling back into the range becomes an opportunity to play a sweep of a mini range, and then using the iceberg at the low as your reference point to play through. Once you get that, the key is once again to be looking for that iceberg break, snap down, and then continued selling. As soon as you get that, you can have conviction. The new sellers are going to come in more as well because they've seen that not only could they sell it towards that iceberg, they have broken it, and there are still more people willing to sell. So in terms of where you execute a trade like this, you've got two options. You can go for the traditional iceberg break down here, or you can use this little range to get in. Once you're inside here, this is where, remember, buyers took control last time and they drove the market away. Granted, some of those buyers were the short, the people who sold down here, taking control, exiting their positions. But if you now find sellers coming in at a point where buyers theoretically should hold some strength, then you get the opportunity to play through this range, giving yourself a new low and then the ability to continue this one onwards once again. And then in that case, the iceberg essentially has acted as a short-term stall within a larger move. Just to remind us, this is where we were chart-wise. This was the bit that we were looking at, this quick drop down and the absorption that took place there. Really, really obvious absorption at the low. Market then bounces away and stabilizes above that mini range. So now, if we fall back into this zone, this is the opportunity for a break. And the way you can play this is either to take it as you come through the low, or any acceleration or any pressure as you come into this zone here. So below around about 99, 99.5, looking for a break through 98. If we get that, this is where you can then look for a further acceleration to the downside, continuation of this movement. We'll get that ladder up and we'll go and look at this. This is the value of noting down absorptions, seeing where they happen, understanding what's happened previously. So if you don't see that, all you see this as is a low. It's just a level, and then you have to make a bit of a guess as to whether you want to buy at the level, sell at the level. Knowing what's happened previous and knowing that the market can't get away from that, this essentially is a level that you expect to break. And so you approach this with the view to sell. What you're looking for now is information to say, yes, you can sell. The iceberg not being there, the iceberg getting overwhelmed, the market pressuring towards the iceberg. All of these things allow for the break of that iceberg. So let's get a ladder up. We're going to have a look at this in action and see what happens. Let's go and have a little look at how this trades. So coming into it, we're trading just above this little range. Now, remember from last time, the volume peaks at 99 and then down here at 98.2. This is the little zone that we're interested in. This is this little execution zone. It's all about remembering what happened down here. If you've seen it, you know what it was like. So you know how the market trades. You know what you can now look for. And it's not about necessarily knowing what to look for specifically. It's about knowing what to look for an absence of. If we don't have the absorption down here, if we keep the pressure when you get to 99, the sellers come back there, either of those things is going to be sufficient to get the drop. You won't see something different from last time. That's the key bit to this. So the first thing to consider is what happens as you start falling into this zone. That sort of quicker move up came from around about 99.5. That's where we're currently trading. So at this point in time, we traded through 99.5 reasonably comfortably. Now down towards 99. Does the pressure come in here again? Do we find more sellers? Absolutely. There is no pullback. So you can now use 99 as an opportunity to try and sell, as we might have done the first time. This is the final kind of test of this move. Do we get any more absorption down here? A lack of absorption down here, the break is on. Because the only reason the market stopped here last time is that absorption took place. People held this. If either that disappears or we now find enough sellers to defeat any absorption that does take place, either of those is sufficient. It's not about deciding it must be one or the other. It's about saying, I'm happy with either. I'm willing to trade either of those opportunities. So down we come. A little bit of trade straight the way through, nice and easy. This way you can now confidently sell below the level. It's fine to sell it slightly below. That's absolutely fine. We'll look at that when we look at momentum breakouts. But now that you've got the break, we know that the buyers are not there anymore. So sellers can now have greater confidence. They've defeated any buyers that were in the market. The move is now on. The continuation's on. You can now start looking down to levels that you've already pre-planned lower down. But the key bit to this was knowing what happened last time. By participating in this move, even if you don't make any money, you've got yourself so much more information. You've got yourself the ability now to plan out this move, to have conviction in it, to know exactly what you saw last time. Any variation, any difference in that is potentially an opportunity to play this through the low, continue the move towards the downside. That's the bit to be thinking about on this. That's what gives you that opportunity. Clearly defined stop as well. Getting back it above this absorption works in the same way as that other gold one that we looked at just previous, where we got the break and back. Another absorption like that, back above 98.2, is a fair reason to get out. So you've got a well-defined small stop on this trade to play for that continuation type movement. That's the value of not just seeing these things in an individual basis, but seeing them over the course of a day, over the course of maybe a few days, a week even. That's where the value comes. That's where you start to find those little pockets of opportunity, those little bits of action that can pay you very, very well because you're understanding of the order flow the last time you were there. The final absorption strategy that we're going to go and have a look at is a kind of momentum absorption in a way, but it's absorption that follows a move. So this is what I call an iceberg continuation. We've seen brief moments of this in previous examples, the euro breaking down, and the concept of that euro holding a market as it starts to bounce off a low is essentially the same thing that we're looking for here. But instead with this, you're looking for this iceberg to come in quickly and progress the move onwards. So it provides an opportunity either to get in after a break or provides an opportunity to add to a trade that you already have. So what we're looking for then is a pullback. Once a market has established direction, you get a short pullback, and as you get this pullback, you're looking for an entry. Now, you don't know that you're going to get an iceberg for your entry, but what you can be looking for, and it can become something in your armory, order flow wise, this is an opportunity. So if you see on a bounce back an iceberg coming in, this is your chance to add on to your trade. You get a nice tight stop on these types of trades because as the market drops, gives you this quick drop and starts to bounce back, there's your opportunity. You see this very, very quick change in the auctioning. You go from a market that's very quick, high velocity down, short-term bounce, but this slows rapidly. Market bounces back up, reaches some absorption. Now, because this is already a situation where you're going against trend, typically a very short-term trend as well, people are not going to rush to buy. Think about it if you're a buyer. You clearly don't need to rush to buy because sellers are coming in and selling to you. So you get this short-term bounce. As soon as an absorption point comes in, you're going to start seeing more people using this as an opportunity to sell again. The absorption stalls the move. You need to identify this quickly. Because if you hesitate and you wait to see, is it an absorption, kind of think this one through, you get to a point where the market's gone before you get the chance to get in. So it provides a clear opportunity to enter, also a very clear tight stop behind it. You don't want to see this absorption broken. Because if this absorption breaks, everybody now who is short from up here is also starting to question their position. But the absorption for people who are already short is giving them essentially a moving stop. So we're now in a situation, if you can identify this quickly, you're expecting continuation. As a minimum, you look for a break of the low. That's all you're looking for initially. If you've got a wider directional move, a larger direction that you're looking for, absolutely play for that. But in the short term, you're looking for a break of the low and then potentially the same type of action again. Another break of low, and the move continues with the extra absorption that comes in there. You can see a failure, and we're going to have a look at one of these as well, where a market starts this format of action, starts to drive the move, but that then creates, like we've looked at with an iceberg failure, a move that then can turn from below a level. So whereas with the iceberg failure that we've looked at previous, you're looking at a reference point that breaks and then is used for this type of move down. Instead, with a continuation failure, you would see the iceberg continuing through this move towards the upside, and the failure to then hold at, say, this high is the point where the reversal comes from. Because if they're willing to iceberg here and here and here, once they're defeated, then the buying pressure is gone and the market rolls back down. So it creates this kind of moving short-term level. We'll look at similar concepts to this when we look at large orders as well. But for now, we're going to concentrate on icebergs and their movement. So, first example, we're going to look at an S&P one where we see two shots at this. We see an early attempt and a clear indication that there is a willingness to sell. And then we see the later attempt where the sell actually takes proper hold and drives the market towards the downside. So the two parts of this trade that we're going to look at are here, where you get an initial break of the low of the overnight session. And then we're going to have a look here, where you get the actual break and the continuation. And there's a distinction between the two. Technically, the first one is always going to be difficult. Reason being that you've got overnight positioning short, you have a previous Christmas tree type profile from the cash session and the overnight session. So both of these indicate that finding enough energy to drive this down is going to be hard early on. The overnight positioning, the Christmas tree, all of these suggest a market is really going to struggle to find sufficient sellers to keep going. And that's fine. But shown the iceberg continuation, you could see this as the exception, the one that may go. It doesn't, but we'll illustrate that. And then once we now start to see balance, and the market once again comes down with increasing volume towards the lows, now you have sufficient information. Now you have the volume, you have the pace of the market, you have this velocity downwards. You've seen what's happened previously as well. So you know there is a willingness of people to sell down here. They just couldn't bring in enough additional sellers. But with the momentum down, with the volume coming in, this is going to bring in new sellers. This is going to bring in the opportunity to get that next leg towards the downside. And that's the bit that we want to be playing for. So like that previous one that we looked at with gold, where the previous absorption helps you understand the next break, this again is the same type of principle. The previous failure to go the first time shows you the type of order flow that potentially could drive you the next time. So don't distrust it the next time. Look at it as this was defeated, but the same action could keep the move going. And so if you see that, you can use that as an opportunity to trade. Let's get the ladder up then. We'll go and have a look at this, and we'll look at both stages. There is annotation to point out when we skip between the two stages as well. Here we go, first drop then. This is the S&P breaking through the overnight lows. Very early on in the session, this is the first sort of drive down of the day. Getting down through or approaching 35, so you're playing this bit of the move here, and then looking for the break of the overnight low, which comes in at around about 32.5. So here we go. There's a drop, 35 trades. And at this point, not really seeing too much here. That's making you think, yep, there's a continuation. So at this point, there's not a great deal to do. You're still waiting to see it try and drive through the overnight lows. That's the main area of action that you want to see. So trade back towards 36, not a great deal doing here, and that's fine. So we've seen the way that it's dropped down just on this early part of the move. And we're going to see this move progress slightly and wait for this break towards the downside. As somebody looking to trade this, you'll think to yourself, right, well, I don't need to be involved at 35. 35 is just below the open. And so that's your chance for the move down, the move through the open. At this point, you start seeing a bit of resistance around 37.5, and you see that from the volume as well formed. So chance to have a go at a sell. Now you want to see this market trade down through these lows to see what we get down there. Can you find sufficient selling? Being aware that with the positioning, with the structure, this may not be likely. But still, there we go. See first little sign of absorption. 35.5, we did 170 lots. 35.75. Again, very quick to get back on the offer, So there becomes your early indication, 35.5. It's only very nuanced, it's only very quick. So what happens as we start to continue this further towards the downside? There we go, 34 3/4, 1,500 lots trades. Doesn't keep on going. That's the danger that we get there. But you're now very aware of the levels, and I'll write these down for you as we move into phase 2. The 34 3/4, there's clearly a willingness to sell down there. So you're watching now for continuation. What's going to happen here? Do we still see this absorption coming in, driving the market towards the downside? This is the acceleration you're looking for. This is what you're after. So now you're watching out for what happens down here. We're not really seeing too much absorption. You're getting a bit more there. 31.5 as well. 1100's done. It's holding it down, but this now breaks. So in terms of levels that you're watching out for, 35.5, 34.25, and then all the way down 31.5. So you've got these references, but as you saw, when you didn't get any continued selling down here, then the market rotates very quickly back up. It's the break of the iceberg, essentially. So it's quite subtle. This is not sort of really, really clearly obvious. Quite a subtle movement. And so we then get the movement onto phase 2. So here we are, phase 2 of the trade. We're starting on this drop once again, so we're now approaching the low of the day. Whoops, that is far from a straight line. We're approaching the low of the day. We know what happened last time we were down here at 31.5. So we now want to see what's going to happen this time. Do we see that pressure come in? If you get below there, do you see that absorption holding below 31.5? If we get that, this is now the opportunity to play the next leg towards the downside. So you look for any reference that's going to give us a clue to try and play this further down. Look for this break of essentially where there is a lot of volume down here. So you can start looking down towards 25 as your next level to sweep the volume that you had from the bottom of this previous cash session. So at this point, it's still now a case of waiting this out. Where's your opportunity going to come? Where can you get into this trade? Remember, any of these levels, if you start coming back up, 34.25 could be one to be looking for. But at the minute, you're just seeing rotations generally sticking around about 32.5. But you wouldn't class that as necessarily an absorption for a continuation. This is more just a market that's holding itself down. It's finding a weight of sellers, and sellers are showing a little bit more willingness, direction of activity, a little bit more towards the downside. Through 31.5 quite comfortably. Now you see 31 again, that trades, any bid comes back, it gets chomped up quite quickly. And again, bid comes back up, chomped up quite quickly. There's the beginning of your absorption. This is the slight difference that you're looking for. That little bit of action that you saw down there around 31. This is the chance now to expect that we could see another leg towards the downside. So trying to bring all these things together. It is subtle the way you see this, but you saw it just there as well. 1700 absorbed, 30, 00. You start to see that little bit more absorption. There we go again. It's not letting it off the low. And this is the absorption that you want to start to see. So now you start to get this break. Market puts in a little bit more pace towards the downside. Are you getting any further absorption? Yes. 28 3/4 you see very briefly as well. This is what you're looking for now. Now you're getting the clue. You're seeing any bounce back, bang, 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 they absorb it nice and quick. You've not really got more than 100 at any price, but it's comfortably selling another 700. We've done 800. Now you get another snap down. This is what you're after. Now you start looking down towards 25 as that first area to be looking for. But the pressure keeps on coming. This is where if you're not already in, you're waiting for any kind of further absorption. You start to see a little bit more there, 25.25. You wait and see these little pushes back. Where does it absorb? And notice it's similar numbers, around about 700 that start to get absorbed. Breaks that and we start to get a bounce. If you're taking this as a quick short-term trade, you can get out. If you're looking for the larger, more directional move, then you can still hold on to this, looking for that move. So now you're looking for, there you go, once again, towards 27, start to see a little bit more absorption again. This is where it did it previously. We're now 1200 that we've got here. So you can use that 27, 26.5 as your resistance. Remember, like I said, when you have a move like this, the absorption comes in. Anybody who's already short is going to see that as their stop. They want to see this keep going. And so also, people will sell there to maintain the direction of their own trade. Now you start seeing further pressure, the market rushes towards the downside once more. And you're looking for the same pattern again, this absorption to come in. You see it again there, 22.25. You're getting up to around about 700s every time it goes down. And it's all about recognizing that same pattern over and over and over. It is subtle, it's not super obvious, and it's never going to be absolutely crystal clear. All you're looking for is a situation where a market does something consistent. And in this case, it was the drop, pulls back slightly, and it absorbs around about 700, maybe up to 1200, 1500, which is what we saw at the early stage of it as well, on that initial breakdown here. So the tone is set. The way the market is trading is shown to you. And that's what you're using to back yourself on these trades. As the market starts to push on, you see that, you can execute on the back of it. Let's go and have a look at another version of this. And what we're going to look at now is a correlated version. We're going to see this action across multiple markets and how different aspects impact markets here. So we're looking at the S&P, we're looking at the Euro stocks, we're looking at the DAX. And we're looking for this breakout, and you actually see in this where somebody actually goes wrong on the trade by assuming that the absorption is complete and now looking for the market to reverse back, and they actually cut and reverse in the Euro stocks around here. But as you see within that trade, the absorption continues. It's a continued absorption. The buy-in just steps up, absorbs higher, steps up, absorbs higher. Now, what happens here, because this is a trade in the morning, the action that comes in, the movement in Euro stocks and DAX drags the S&P up. As the S&P gets forced higher, it actually releases and you get this stop type move because the correlated markets are pushing on. And as they do so, the S&P then breaks, quick zip up, and then you start to see the absorption continuing towards the upside in the likes of Euro stocks, in the likes of DAX. So the main areas to be watching out for. You're looking out for the DAX once you break 121.34. You're looking for the Euro stocks as you start to break through 33.55. They're the main areas of action. This causes the forced jump in the S&P and this general correlated move towards the upside across the three markets. So let's go and have a little look at this. So this is seeing it in action. It's less to do with the charts, albeit the charts give you those points to break, but it's the action, the sort of correlation when you see this across three markets, you see them how they're all sort of stepping up together. Let's get this one up. Here we go. You can see markets already moving, and what we've got here is a situation where we've already got some bids in the Euro stocks. Remember, the DAX high, 134, now got filled on one of the bids in the Euro stocks. You can see already where the volume has been put in lower down, 52, 53, 54. So we're watching this moving up. There you go, the DAX jumps through the high of the day. The Euro stocks now bids up slightly. So all of this is now playing into this continuation move. We're not seeing a great deal of absorption anywhere at this point in time. And this is where you're watching the three markets to see how they're moving with each other. DAX has already moved through the high. Euro stocks has pushed through the high. The S&P's barely moved. So at this point in time, you've actually got a degree of absorption at the high in the S&P. Now the S&P jumps. So the S&P's kind of played catch up there to the DAX and the stocks. And so we're now watching what happens with these. Can these progress this move onwards, or is this merely a short-term jump in the S&P, forced move up, and nothing more? So you start seeing Euro stocks. Again, watch the 59s now. We traded 3,600 nearly at 59. Bid moves up, selling comes in still, absorption, absorption, absorption. It's very, very steady. There's not loads and loads going on. There you go, 3,800. Immediately the bid holds. 4,000 is traded. This is your continued absorption. This is showing a continued willingness to press towards the upside. Yeah, little sell back, the 59s hold, immediately you get a bid back at that price at 60. There's your continued absorption. So you're now looking at, clearly, Euro stocks being the strong one. The S&P is actually getting absorbed on the upside here. So there's people willing to sell 63 in the S&P. They keep on absorbing this. So the S&P is the one with the weakness. The DAX now releases because of the constant pressure in the Euro stocks. And the Euro stocks continues to push on. The S&P is essentially being forced up because it can't maintain prices lower down with the drive higher that you're seeing in Euro stocks and DAX. There we go again, 63 in Euro stocks. It traded up, we got a bid, traded into the bid, we get a quick offer. Now that at this point isn't suggesting one way or the other for an absorption. You now start to see very quick 63, trade 64, bid, bid. Now when you start to trade back, you see where the volume is, and you see again, very, very quickly, each time we trade into 64, the order comes back. We had up to 1,000 on the bid, it trades 1,100 trades, 1,200 trades, then 2,500. We're constantly reloading this to around about the 900, 800 area. Every time it drops to 300, it gets hit into, it reloads back up. So this is giving you the indication that this is a market that is maintaining strength. It's only moved 10 ticks. It's not a gigantic movement, but it's this constant pressure that is being built. People are still willing to just lift their bids up, pay slightly higher prices all along. You see it again there, constant selling into 63, and the bid just returns. Even when it goes offered, very little trades down, the bid comes straight back. And this is where the mistake's made. There is an assumption that it's already turned. If you're going to get an absorption reversal, you're expecting the market to turn, hold the offer, and then start to hit into the bid. This is too quick. this is a jump in on the back of clearly a very strong move up, assuming that we may well have found the top. It's preemptive without needing to be preemptive. That's the danger in a trade like this, because now that it's settled down again, the bid's held, we trade another bid up, now you're trapped. Because like other people, if you have been selling here, people selling into the bid as it reloads higher, now you've got 5,000 people or 5,000 contracts potentially trapped here. And if we start to see absorption coming in at 64, you've now got a lot of positions trapped, another 5,000, so that's now 11,000 contracts nearly that have got trapped there. That's the difficulty with a trade like that. That's where you can get trapped if you preemptively reverse, because by preemptively reversing here, you're trapped as the market continues onwards the next leg of that move. The point there being, as the absorption moves up, you can follow this. Even if you're not adding, you can follow that up, use that as your new base, which is going to drag other markets up as well. And in seeing that, the one thing you don't want to get caught out on is just trying to reverse. Yes, it did get overwhelmed very briefly, but it was only brief. And the other key aspect of any kind of reversal is that the absorption, one, needs to be defeated, and then you need to see selling in the other direction, selling into the bid, and you didn't see that. It was minimal, small eclipse down. So there was a lack of volume in each trade. There was a lack of speed with which each trade took place. That's always going to be a danger when you're looking at an absorption reversal. And that was where this trade gets caught out on the trade, where they're trapped, and then where they're at the mercy of this next leg towards the upside. Final thing we're going to go and have a look at then is one in oil. And this is an example where you get the absorption continuation that then fails to keep the move going. Technically, this looks wonderful. Technically, like that S&P one that we looked at previously, you have a caught in the hole. So we're looking at this as an opportunity to then try and get short, either as you come into the range below 102.75, or as you start to break through the open at 102.30. That's going to be your upper opportunity. There's your open. So this is the bit that you're looking for to break through here, and that's then going to lead you down to the top of value. So essentially getting you all the way down here to 150. So that's what we're after. But what you get is you get an early chance to get in. You get the absorption as you get on down into the previous day's range. There's your big opportunity. But the problem with this is the opportunity doesn't play out. The absorption helps, and this continued absorption starts to push down. But as soon as it's defeated, now the move's over. So you always have to be aware of this, that if you're playing using that continued absorption, that effectively becomes your stop as well. So as the absorption pushes down, your stop moves down. If it can't hold on any pullback, or that absorption is then defeated, then you run the problem of the market reversing quickly against you. That's exactly what happens here. That is one of the dangers of this type of trade. Every trade has its own danger. It's about understanding what the danger is. If you recognize that here, and this is why I want to show ones that don't work. It's great and easy to show ones that do, but you need to be aware of the ones that don't and what happens when they don't. So let's go and have a little look at this example in oil. So now it's starting to drop down. Now remember, we're looking for a break of yesterday's low at around about 102.75.80. So this area just down here. That's the point where you're now looking for the pace to come in towards the downside, where you can start to play for this move all the way through value, taking you down to sort of 150. So that's around about 200, 225 tick potential. So we start to drop down. Now, if you want to try and play it back through the previous high, that's fine. You can see that we just stalled down at 102.75. Holding down here is going to be your opportunity to play the break. You're seeing very quickly 75 to 80 bouncing up. You could put an offer in at around about 80 to try and get short. Alternatively, a break of 75 is your other option on this trade. So that's the first aspect of the trade, and the first way that you might want to try and take this on. What we're looking at here, and I'll get rid of the volume profile so you can see this clearer as this market moves down. We're looking for, remember, a break through the previous day's high as your opportunity to get short. So this comes in at around about 102.80, 102.75, this area that we're currently trading at. So that's your opportunity for the short to play the caught in the hole. Confirmation of this is going to come with a break of 102.30, the open. So you're looking at this thinking, right, well, how am I going to play this? Your obvious opportunity is to try and play it through 75, which is this little established low. And when you take the volume profile away, you start to see it building this little range, 75 towards 80. So you could drop an offer in at 80. There's an opportunity to get short. Alternatively, at this point in time, your only other way of taking the trade on is to sell it through 75. So there we go. Market's dropped down. So opportunity potentially missed. So how else do you take the trade on then? Well, now we start to watch what's going on down here. Start trading 61, and still at this point, not a great deal to be doing. There's nothing obvious jumping out that says, yep, you've got a trade here, you need to be getting involved. You trade back towards 61. There we saw a quick little flick of action. And again, 63, we've now done 136, 145, 181. Now you can have a go at selling. There's your continuation absorption. 220 now trades. Compared to everything else, this is huge. So now you've got a very clear reference point. Flick back up, we've broken the absorption. It's instant. This is that failed break of absorption. 300 is now done. So now you have your reference point. Your expectation now, or what you're looking for now, is to get down towards 30 to play the next leg of this move. There we go. Nice snap down. At this point, you're thinking, wonderful. This trade is all looking good. I'm in a great position now. I can look for a further move towards the downside. So that's using that absorption to get you in to maintain your position. Ideally, you want to see this continue now. You want to see this come down at lower prices to maintain that pressure. But it's done its job of breaking the level for you, or providing you an entry point after the level. Quick rush back up. We get filled again, 63 trades again, and holds again. Absorption once more. And this is fine. You're happy with this. What we don't want to see is it breaking and it's now starting to trade up. Remember, your stop was 70, or where it previously traded was 70. Now we've jumped through, and this is the danger that you get, that once it jumps through, anybody who's been short using that absorption down at 63 is now trapped. And this is where you can end up with a market that runs away because it's jumped back through that absorption. The continued absorption does not hold. We're now back above it, and we end up with this dangerous situation where if we don't get back down here quickly, which is clearly not doing, you're going to have a lot of people who are now looking at this thinking, I'm in trouble and I need to get out. And that's what creates this quicker flick back up. So there is a danger in a trade like this. I always want to try and illustrate the danger side of a trade like this. If you're still short, you now don't know what could happen from here. You could have a situation where this is just a wider flick back up and we're going to go again. You could have a situation where this is going to hold 70 and we're going to get a run back higher. The understanding of what can happen from here has gone because your reason to be in the trade has been defeated. The absorption continuation that came in, the market drops, the absorption follows it down, wonderful. But if that doesn't keep coming, you're in trouble. And that's part of any kind of trade. You have to be aware of where it can go wrong. As soon as it shows signs of being wrong, you step away from it and you say, I don't need to be part of this anymore. Take your loss at 70. A 10-tick loss, even a 15-tick loss on a trade like this is perfectly acceptable. You're looking at this point to be selling 60, break 30, and you're looking for a move down to 150. So this is a situation where you're looking for around about a 200-tick move with a 10, 15-tick stop. It's an entirely acceptable risk to be taking. You've been given an ideal entry, and on a good day, given this type of situation, it may well be that you don't even see yourself once offside on this trade. We trade 30, the continued absorption follows down, and the move keeps going. It's about knowing the reason for being in the trade. This is good enough reason to be in. Of course, it won't always work, but you're taking a measured risk. You know what you're trying to play for. You know what your risk is. That's an acceptable trade. That's one of the key things with any kind of order flow pattern. We've gone through all of the absorption examples. We're going to move on to large orders. With any order flow pattern is, what are you using the order flow to do? And that's a key question to ask yourself whenever you see any example of any kind of order flow on a ladder. We'll wrap it up there. We'll move on towards large orders now and see how they do have some degree of similarity to an iceberg, but with a little bit more of a final and defined finish to them because you see the size of the order themselves. Key question here, are they genuine? We'll be answering that next.